Welcome to today's webinar, Finance 101 for Startups. I'm Eric Yang, Head of Partnerships at Atrium, and your moderator for today. On to logistics. This webinar will be roughly 45 minutes of content and Q&A. You can submit questions at any point during the webinar on the left side of your screen. Now, let's get to know our speakers a little better. Jake?
Hi, my name is Jake Fohn. I started my career at KPMG for 4 years, where I focused on working with startups in the audit practice, and I am now a solutions architect here with Pilot.com.
Hi, I'm Carolyn. I'm a finance lead at Pilot. I help with pricing, growth, and sales strategy. I started my career at EY in accounting, and most recently was on the finance team at Dropbox.
So with the introductions of the rest of us, here's a look at our agenda. We'll be talking through what it means now that you're a startup or a starter of a company. We'll look at cash versus accrual bookkeeping, financial statements, and what you'll need to do now. Let's pretend, Carolyn, that I just started a brand new company. I'm the founder. From an accounting perspective, now what?
Yeah, great question. So the first thing, and this is one of the most critical that we recommend to founders, is do not mix business and personal expenses. What we mean by this is do not use company money on personal expenses. This concept is something the IRS calls commingling. The IRS cares a lot about this distinction. The business is its own entity. It should be making and spending its own money. Similarly, you are your own entity, so you should make and spend your own money, and you should be keeping these two separate. If you've separated your business and personal expenses, the next thing you can do for good hygiene in this kind of area is to have the company spend the company's money. What we mean by that is rather than you buy something and the company reimburses you, it's simpler for the company to use a business debit card, business credit card for business expenses. We recommend this because it's a really clean separation of expenses. It's very explicit what the company spent on company-related purchases. It also reduces mental overhead for you. You don't need to submit reimbursements. You don't run the risk of forgetting to reimburse yourself for something. So it keeps things clean and separate and reduces any extra paperwork you have to run on your end. If you're looking for what's the best case scenario, what can I do now to really set myself up for the future, we recommend doing the investment now to set up a great financial stack from day one. When we recommend this to founders, a lot of them say, this isn't a priority right now, it's not really affecting me. But what we come back with is precisely because it's not a problem for the business is why you should do it now. When it becomes a problem down the road, you'll wish that you had set it up earlier. We hear that frequently from folks who come to us for bookkeeping. And also, you'll never be less busy than you are today. That might be surprising to hear, but as your business grows, your to-do list is only going to grow. And so it's actually a great time to set this up now, and then you won't have to spend the time thinking about it later.
So that's great news. It's like debits, credits, assets, liabilities. As a startup founder, help me make sense of how bookkeeping works.
Yeah, absolutely. So let's talk a little bit about the concept of double entry bookkeeping. Double entry bookkeeping is a system for tracking how money moves into and out of the business. In double entry, the idea is that every transaction in the system will move from one account to another account. So a transaction is always going to affect at least two accounts, and each transaction is either a debit or a credit. The total debits and total credits have to be equal in the entry. The requirement for debits and credits to equal is actually a great way to prevent errors. That's kind of the whole idea behind double entry. If these entries don't balance, then you know something is missing in your books. Let's talk through a couple examples to actually visualize this a little bit better. Say you have a business checking and business savings account, and you transfer $100 from savings to checking, something probably everyone has done. The way that this would be recorded in double entry is that $100 moves from savings account and to your checking account. So we have both sides of the entry there, and the $100 would balance on either side. Let's talk a little bit, slightly more complex example. If you buy a stapler with your business debit card, $10 again will move from your checking account to your office expenses account. And tracking this as money leaving your bank account and increasing your expense account, in this example, office expenses, lets you go back and look at the month and see what you spent for that specific account in a month. This is really helpful for managing your business, seeing what you spent in a certain expense account. But again, we're making sure that the entry balances by moving $100 from one account to another account. Third example, slightly different, would be thinking about customer payments. If one of your customers pays you $1,000, in the double entry system, this would be reflected as $1,000 moving from an account called sales or revenue to your checking account. So these debits and credits and the idea of double entry in general is the true foundation of bookkeeping.
Great. And in that last example, you talk about if a customer pays you, at a certain month, you would record in your bookkeeping. But I've heard that timing matters with revenue and expenses, and how it can change the outlook of your business. Could you help clarify what the difference is and why timing matters? Is there a preference or a method that you would prefer over another?
Yeah, absolutely. So we just talked about how every transaction is cash moving from account X to account Y. What you mentioned is the question of when do you actually record these transactions? So when we get into this question, we're talking about cash versus accrual bookkeeping. Cash basis, you would record the transaction when the money is spent or when it is received, whereas on an accrual basis, you'll record the transaction when it is billed or when it is earned. So that concept might seem a little vague or confusing, but let's talk through an example here. Let's say your company sells widgets. You sell $1,000 of widgets in March to Kate, and she pays you on April 1st. In April, you sell $1,000 to Jim, and he pays you on April 15th. On cash basis, you would have $0 of sales in the first month, in March in this example, and $2,000 in April because you collected all the money in April. And this is reflected just in the little chart on the top right. So when you look at this, you might think, oh, March wasn't a great month for sales. Maybe we should look at April as a better indicator of what we should be doing from a marketing perspective. But in reality, you did have one sale in March and one in April. You just received all the money in the second month. And so for cash basis, it can look a little lumpy and might not tell the full story. In accrual, the second chart shown here, you'll book your revenue or expenses when they're billed or earned, even if the cash hasn't moved. So for this example, you would book $1,000 for your sale in March and $1,000 for your sale in April. And again, the timing of the cash doesn't affect when you can book that entry. When you use this method, it often looks smoother and more even. We definitely recommend accrual as the way to go for sophisticated and growing businesses. It captures more information about how money moves in and out of your business, and it's less lumpy. It's also the method that all large companies move to. So it's definitely better to get on this method sooner rather than later.
Great. And then there's so many numbers to remember and analyze when you're looking at bookkeeping, assets, liabilities, everything there. What would you say are the most important metrics of a founder, or that the founder should focus on early on?
Yeah, definitely. So as the CEO or founder or business owner, there are two big numbers that you should care about. And what's interesting is these numbers are actually on a cash basis. So what these are is, the first one is cash in the bank. How much money do you have right now? You can go into your bank account, look at the balance. That'll give you a quick tell of what that status looks like. The second number is burn rate. So this is a calculation based on how much money you're spending every single month. That will include some of all your expenses, payroll, rent, advertising. This is offset by revenue. So how much you're spending offset by any revenue you're taking in. Let's say that you are not yet generating revenue, and we go on to talk about the idea of runway. So you'll take cash in the bank and divide by a burn rate to see how many more months the business can continue to exist without additional funding. So if you continue to spend at this rate of spending, again, saying you're not bringing in any revenue yet, how long will it be until you run out of money? Generally, the trend we recommend for companies, particularly venture-backed companies, the goal is to not let this number fall below 6 months. When you're out raising money, if your investors know you're almost out of money and you really need some cash, it's hard to get that money on good terms. So ideally, you want to raise money in advance of when you need it. And the best way to do that is to keep an eye on burn rate and runway, which we just covered. Yeah.
Awesome. This is super helpful information. And Jake, I wanted to ask you a quick question. A question that we often hear from our founders is that investors want to see the books. Can you explain to our listeners what the books refers to?
Yeah, for sure. The three statements that they're often referring to are the balance sheet, the P&L, and the cash flow. For startups, there are really two reasons you need to have a good set of books, and oftentimes the first reason is to make sure you are in compliance and appropriately filing your taxes. Your tax preparer will say, hey, Send me your books so I can appropriately file and pay your taxes. And ensuring the accuracy of the numbers that are being represented is truly crucial. Without a good foundation in place for bookkeeping, it's hard to do so. Ideally, management is also looking at this stuff as well. And once you learn how to read them, they can tell you a lot about the health of your business, how much you're spending, how much you're making, where your money is going. Management will be able to use these statements to more effectively drive their business in the right direction. It is important to note that these statements in their nature are really backwards looking and do not tell the whole story. They are a great way to see what has happened, but might not provide you all the insights or metrics that you would like to track. For instance, if you're a SaaS company, metrics like customer growth, recurring revenue, or churn rate. But nonetheless, your financial statements are built upon the foundation of journal entries, the debits and credits, which Carolyn mentioned earlier, and without these, we cannot build these statements accurately.
Now, you talked about all these different things: income statements, balance sheets, statement of cash flows. Can you help me dive deeper into all these financial statements and what they mean?
Yeah, sure. Let's start with the P&L, which is often referred to as the income statement. And this statement really describes how much money you made and spent over a given period. This is about the delta, not really where you started or ended, but the change over time. And there are four key, really operational segments in the P&L which are important. The first is your income, which is the revenue that you generated through your business. The next is the cost of your goods that have been sold, which is if you're making a specific product, these are the costs that you incur to make this product. For example, if you're a SaaS-based business, the costs associated with hosting and running the production environment, either the IT or the people behind that process should be mapped to COGS. And you want to keep these separate from your miscellaneous expenses because these expenses might grow linearly with your revenue, which is expected, and you will want to see that and be able to track that separately from your general expenses. Then the next category is your general expenses, which are more so your operating expenses. These are sales and marketing, your legal, research and development, professional fees. And then lastly, the fourth thing to consider, which is at the bottom of the P&L, is your other income or other expenses. And this is really money that the company has made or spent on things that are not really related to the core business. So an easy, quick example of that is earning interest on your bank account. Yes, the money that you've made on your bank account is income, but it is not from your core business. So now we're going to move on to take a look at a sample P&L. And this is really a good sample to look at for a startup because there's no revenue, no cost of goods sold. It's really just in the ramping stages. Now, a couple things to point out here for this sample P&L. Best practice is to have, header, general ledger accounts to organize your expenses, and then sub-accounts to more specifically categorize what the expense relates to. So here you can see we have payroll, general and admin, sales and marketing, your professional fees. And it's important to have these sub-accounts, but it's also important to remember, don't go into overdrive with these accounts. You don't want just a single GL account for every expense that you may have. Now, the P&L, it is a pretty good idea of where your revenue or expenses came and went on a monthly basis. You can tell a lot just by looking at this statement, and it's really most interesting when you compare it looking month over month. And as you look at this sample P&L, or your P&L, you may identify trends you were unaware of or strategize areas for cost saving going forward. The next that we're going to skip to is the balance sheet. And unlike the P&L, the balance sheet is truly a snapshot of the business at a point in time. It's what you have and what you owe, your assets and your liabilities. And the most common phrase used for the balance sheet, really the fundamental equation of accounting, is assets equal your liabilities plus equity. Or more so, the way I like to think about it, it's your assets, the things that you have, minus liabilities, obligations that the company owes, equals your equity. And equity represents the book value of your company. It's the amount of money that would be distributed to owners or shareholders after assets are liquidated and all debts are paid. And it's probably a good point to make here that this is not your startup's valuation or what a VC firm would say, hey, your equity, this is what you're worth. Now, the equity here on your balance sheet is truly just the difference between what you have versus what you owe. So now we're going to take a look at an example balance sheet, and we're going to start at the top here, looking at assets, which the first thing that's always shown is like the cash or your bank balance, what you have. But then you go down into other assets, which can be things on your books like short-term investments. But it's also important to take into consideration somewhat, very related to what Carolyn spoke to earlier, the difference between cash and accrual. These other assets, it's important to take into consideration things that you may be owed or have already paid for but have not yet received. Things like prepaid expenses or accounts receivable where you have performed a service but have not yet received the money from the customer. So things like that are important to consider and definitely are differentiating the difference of cash basis versus accrual basis. And as we move down a little bit into the liabilities, your liabilities are really stuff you owe people. Either it's a loan from someone, your credit card balance, a service that someone performed for you that you have not yet paid. These are the liabilities that are important to track. And then lastly, the equity here, this is largely stock, like your stock options, your net income, and any financing that you may have received. Ultimately, it's called the balance sheet because it must balance. Now, moving on to the cash flow statement. The cash flow statement shows you all the money that's moving throughout the business for a given period. Now, for larger companies that have a ton of cash, if you're a public company or just have a large cash balance, it's very important. This financial statement helps you identify the cash outlays and the cash inflows. However, for small companies, this might not be as useful as the runway or burn report, because for small companies, you may be looking at your cash balance more on a monthly basis, and these reports, the runway or the burn report, truly show you, kind of what cash looks like on hand.
Awesome. So just a quick reminder, guys, if you have questions, feel free to ask those questions and we'll get to them at the end. But going back to cash flows, so I know that you can record cash flows as it comes in. However, what if, again, I was a startup founder and my company wants to collect a year's worth of fees up front? When do I record this?
Yeah, this is a very important thing to consider for accrual basis bookkeeping, as well as, the new accounting guidance that has come out in the past few years for accurate revenue recognition. Oftentimes, startups, you work very hard to land your initial customer or customers. And there is a ton of thought that goes in an effort to landing that first customer or those initial onset of customers. But not a lot of thought maybe goes into actually, hey, how should I recognize the revenue once I have earned it? And the main principle to understand is that just because cash has been received, revenue might not have been earned. And it is important to identify the performance obligations that must be fulfilled over the contractual period and ensure that you are recognizing revenue over that time and in accordance with those deliverables that are being provided to a customer. To give a SaaS example, just a customer signs up for an annual subscription, and just because they have paid up front doesn't mean that you can take all that cash right now. You'll need to amortize and recognize that revenue over the contractual period.
Awesome. That's good to know. Now, there's so much to remember about all this accounting. And again, wanted to remind people that the Q&A section's on the left side of the screen. But with all the numbers that you have to kind of memorize and know and just keep track of, what's the best way to manage all of this?
Sure. Before maybe we talk about how to manage it, maybe let's talk about a few common pitfalls or mistakes to avoid when starting your business or when you are getting started. We mentioned this earlier, but it's very important. I think if there's just one thing that you take away from this webinar today, it is do not mix your company's money with your own money. It's important to have separate business credit cards. There's a lot of great business credit cards out there right now. It's important to have things separated so you can appropriately track them. Another common mistake that we often see and a suggestion that we like to make is always use a payroll system to pay your employees. The reason that this is important is that it helps calculate payroll tax withholdings when the necessary time comes up, and it's something that you're not going to want to do by hand, trying to calculate later. It's very important if you have these payroll systems set up, they will track this for you. It'll be accurate. It'll be done in real time. And, just another side note, it's really important too, if you are using a payroll system, to update your employees' addresses when they move, to make sure that you are appropriately accounting for the tax withholdings wherever that employee is based. Another thing to consider is file your corporate tax returns. Even if you're a startup, you're operating at a net loss, you don't have any income, it's still very important to do. And on top of that, corporate income tax might not be your only obligation. There are often other regulatory filings you need to make, and it's important that all those obligations are met for your business. So talk to a good tax preparer to make sure that you are meeting all your requirements. Now, to your original point, Eric, how should I manage all this? When you are busy in the early stages of your company and doing a million things at once, it becomes very important to delegate tasks off your plate. More specific to finances, I think it's important to talk about the tasks that keep your company moving forward versus the ones that you should offload to your bookkeeper. Tasks like paying your bills, your employees, or other business expenses, or maybe building revenue forecasts. These are all things that keep your business staffed, operating on a monthly basis, and moving forward. Whereas closing your books on a monthly cadence to ensure that everything that your business has done is appropriately accounted for, or further, preparing the deliverables needed for your tax preparer after the fact, are all things that are best delegated to a bookkeeper. Here at Pilot, we can do bookkeeping and file all of your tax needs, taking care really of your whole back office while you continue to run your business full steam ahead.
Great. That was a lot of good content here from both of you guys, Carolyn and Jake, so appreciate it. Now we're kind of moving on to the Q&A questions, or Q&A section. We've got a couple questions come in, and we'll do our best to answer as many as we can. Well, the first question is, if our SaaS company has more than $1 million in revenue, can we still be on the cash basis, or is the accrual method better? Is it difficult to switch between both?
Yeah, this is a great question. So I want to touch on a couple points here. According to the guidelines, as long as your sales total less than $5 million a year and you don't handle inventory, then you and your tax preparer can decide whether to use cash or accrual basis. It's not extremely difficult to switch, but it does require some more advanced bookkeeping. We generally recommend the new year as a great time to switch to a different method. So, we're kind of getting to the end of 2019. You could start in 2020 on accrual basis, set up, everything you need in place to do that. And then in terms of the IRS, you just need to file a form at the end of 2020 saying that you actually switched your taxes from a cash basis to accrual basis. Thinking about timing, which is another question we get related to this question, is, what's the right time to switch? And there's no kind of right black and white answer here, but there are a couple considerations we generally raise. One is investing. So when you present cash books to your investors, it sometimes looks a little bit less sophisticated, especially as your business is growing. You'd want to move to accrual and kind of show them that you take your book seriously and you're investing the time to have the proper set, especially when you're sharing with them and talking through your forecasts. It's also something you should figure out sooner rather than later. So if a business comes to us and says, oh, our investors are asking for accrual basis, by next month, things like this do take a little bit of time, especially if you're trying to do something mid-year, which we, again, recommend doing it at the year boundary. But it is important to keep in mind, it does take a little bit of time to make the switch. So I think you should kind of think about your business. What are the big, milestones or next steps that you have in mind over the next year or so timeline, and use that to help frame your thought process about when is a great time for you to make the switch.
Awesome. Another question is, how does revenue recognition apply to an on-demand marketplace model where you don't have a contractual basis?
For sure. I think it's good to think about if you are exchanging something over an online marketplace where someone's purchasing something online. If it comes to the fact that you have delivered that product and someone pays you for it, you have no further obligation to do anything else after that period, the revenue can be recognized right then.
Awesome. And then in the example about the annual subscription, another question that we have is that, let's say you've amortized the revenue over a contractual period. Does this mean that you would divide the annual subscription fee by 12 months and then record revenue of $10 earned each month?
Yeah, that's exactly right. And this can get, a bit more technical, determining, or just when you take a look at what the performance obligations are. If the performance obligation is simply, hey, I've paid for this subscription, I get to use this, and there's nothing else that you need to provide to the customer, then yes, you take that 1/12 of revenue in the month that they sign up, and then going forward, you recognize the rest over, each month subsequently. There could be, further technicalities where maybe they paid for an onboarding for the first month, where it's a professional fee that is, it takes your engineers to set up that software, that subscription, or something to help your customer. And then they pay for the annual subscription after that. Those are two separate performance obligations that you need to think about and you need to consider. Whereas, the performance of setting the customer up to use your software or use your subscription or something like that, you would recognize that once you have basically pressed go live for your customer to use that. And then the subscription piece would be recognized over the life of the contract.
Awesome. And another question that just came in, for contractors, how important is it to use a payroll?
Yeah, this is a great question. So I think for contractors, we don't as strongly suggest, need to be on a payroll system from day one. There are, a lot of the payroll systems out there will be really helpful for you for paying contractors in terms of collecting the information you need for 1099s and things like that. But you can use something like bill.com or a bill pay through your bank for contractors, because there's not the same requirement level for payroll filings as there are for full-time employees.
Awesome. And we'll just do a couple more questions just because that's all we have time for. But if you have more questions, feel free to reach out to either one of our companies, Pilot or Atrium. Another question that we have is, we just started at the beginning of the year and unfortunately had mixed personal and business to some degree. What can we do to remedy the situation?
Yeah, I think the first thing is stop doing this now. But going forward, using those business credit cards is very important. I think that, looking backwards to your point, hey, I've maybe already done this. I hadn't heard the Finance 101 yet. Here's what I would suggest. I would just let you know that it's important to make sure that you get it right when you go back, what was personal versus what was a business expense. So maybe the best thing that comes out of today is it's just somewhat of a red flag to you, where you should know, hey, it's okay that I've done this, but I need to make sure that I go back, either sit down with a bookkeeper or just personally go back by myself and make sure that I really carve out what's business and what is something that should be a personal expense.
And we'll make this the last question, but we're getting a lot about the financial stack and what a good financial stack looks like. I was wondering if you guys could finish off the webinar by answering the question, or at least providing some insight to what a good financial stack looks like.
Yeah, I think one of the things to raise here is that there's a ton of great providers now for payroll, for bill pay, for invoices that are online and tech enabled, and that's generally what we recommend. Like, for an example of how you can really bring your invoices process to a great financial stack would be to stop kind of drafting them in a Word doc and sending them out that way, but actually going into a QBO and drafting them that way, going into bill.com. There's a couple of benefits of moving into more tech-enabled software like this is to, one is that you gain a lot of the efficiencies from the technology. So for the invoices example, you can save customers in there and kind of use that information when you send another invoice in the future. And you also kind of reduce errors because it can tell, oh, you sent an invoice to this person last time, but actually use a different address. So, it'll help you to catch errors like that. In terms of some we do recommend for banks, Silicon Valley Bank, one of the things that we really like about them is they're startup friendly, great reporting options. They also have something called a cash sweep. And so it'll take the money that you're not using in your operating account, move it into another account, and you actually get some great interest from that. For Chase and First Republic are also some really popular options that work well for startups. For corporate cards, previously we were recommending Brex. I know there's a couple recently new players on the market, so we're getting to know them a little bit better. But Brex was designed for startups. It's super simple to get started, no personal guarantees. Those are a couple of reasons why we're big fans of working with them. Expense reporting, this is another area where we really recommend the tech stack. We have some customers who come to us and say, I'm tracking this all offline in a spreadsheet, and that can make your bookkeeper's life a little bit more difficult. So one thing we recommend here is Expensify. It's actually pretty inexpensive. It's really flexible. You can kind of take a picture of a receipt from your phone, upload it. It integrates really well with software like QBO. And then I'll just mention a couple other. For payroll, we do recommend Gusto. It's really modern, very popular startups, handles payroll taxes automatically. And also, like I mentioned, it works really well with handling any contractor filings. And then credit card processing, Stripe is kind of best in class, easy to integrate with, transparent fees, and QuickBooks Online. And then I mentioned some invoices. And for AP and AR, Bill.com, we find to be the best option there. It automatically collects recurring invoices, securely stores your customers' banking information, and then it will initiate and move money for you. So it definitely significantly improves the process both for AR and AP.
And I think just to piggyback off that, Carolyn really got everything that we should kind of hit on or speak to. But just to reiterate, there's never gonna be a better time than today to get the best-in-class stack going. You're going to become more busy. Your business is going to be, just the speed's going to be increasing. And taking care of this from an early stage in your company is very important. I think that setting a good foundation, a good financial stack, will just help your business in the long term.
Also, as Pilot, we have extensive experience working with hundreds of startups, who have different needs, use various providers for different purposes. And so we have a lot of great expertise to help in this area, kind of a business consulting role. So that's kind of the benefit of working with a provider like Pilot, is we are able to leverage our deep experience to help you solve some of these problems.
Awesome. Thank you guys so much for coming and joining us on this webinar. You can feel free to reach out to either of us or any of us on LinkedIn. If you have more questions, feel free to shoot them over to either hello@us.co or to the Pilot team at hello@pilot.com.